Hello and good morning, listeners. We are beginning with a quite an important week, which may be a very long time for the financial markets. This is Almus Market Mornings with Shikhar Garg. And yesterday we got the news of UBS deciding to buy the troubled Credit Suisse for approximately 3.2 billion dollars, just like it happened during the 2008 crisis, wherein JP Morgan bought Bear Stearns for USD $2 a share in the mid March 2008. This was followed by a coordinated central bank action, something which we also witnessed during the pandemic, with Fed supplying the USD liquidity to other major central banks in case required as the last resort lender. Now, this is also a daily window for the liquidity. And why should it not be? Because you see, the yields have been quite volatile, and such a move is not witnessed without precedence. We'll have to see how the Fed responds to this, as they are again in a very tricky situation trying to balance between the financial stability and the inflation battle. So, JK, what do you think about this week ahead and Fed's expected actions?
Yeah, good morning, Shikhar. So, actually, just before I start my update, I would like to point out that things are changing so fast, and developments are also coming in so quick succession that sometimes in our update we may actually miss out what is currently happening also. So it's just that we keep looking at our ongoing updates to be well informed of what is happening. Yes, as you said, the UBS Credit Suisse marriage happened, but I think that happened at a gunpoint because the central bank was involved directly in the negotiations, and UBS was reluctant to take over, and they were initially paying only 1 billion. Ultimate price was much more, but there is a lot of guarantee from the central bank as well. So, is it a good news? See, good news is, it's irony is that the good news is also reflecting how bad things are, and it's great that we are seeing this concerted effort from central banks, who are also now, as you said, infusing a lot of liquidity, particularly to the banks, so that the credit flow continues. It is positive, but also highlights how troubling the circumstances are and how worried the central banks appear to be as well. And Friday was one of the most nervous days in the trading. First Republican share and the Credit Suisse shares were falling again in a big way. And then, despite Credit Suisse apparently tapping 54 billion $54 billion from the central bank as a liquidity, and then a consortium of banks including 30 billion liquidity into First Republican Bank, and then the SB Financial Group, which obviously which started the entire ball rolling, actually would be seeking a Chapter 11 bankruptcy protection. That was the thing. Then there was this report about how Fed discount window was being tapped, and almost 300 billion was borrowed by the bank. So investors took it as a sign that almost everyone who in the lower segment of the banking system were in trouble, and that is why so much of liquidity was being withdrawn. There are, of course, Fed had started the backstop immediately after the SVB crisis figured out, came out. And that's actually a good thing that more institutions have not failed, at least for now. And one of the reasons they are also giving so much of liquidity is also that what is seen is that money is being withdrawn from smaller institutions and being put in larger institutions just to ensure the safety. And this is done online, and because of the current technology that is available. And so banks really are being monitored by the central banks on an ongoing basis. But again, as I said, it is not the end of the crisis, or it is, this is just some measures, and central banks will remain vigilant for more signs of stress. So far, US and also Switzerland banks have been shown up, but European central bank has said that their bank system is safe, and they have also raised the policy rate by 0.5%, which is seen as a sign of confidence in their system. So now, what have the impact is, of course, Dow, which had overall US markets had fallen on Friday, but on a weekend basis, they were not so down. In fact, Dow was the only one which was down. Nasdaq and S&P 500 were fairly in somewhat positive territory. It was the bigger move that was seen in the European stocks because I think they were outperforming other markets. And as soon as the risk aversion came, I think investors rushed to take profit in that. As far as the yields are concerned, they have been as volatile as they can be. And 25 basis movements in a day has become very common nowadays. After Friday's nervous moves, yields did fall again, but did not break the previous day's lows of 2-year did not break the 3.72%. And today, they after the overnight events of UBS Credit Suisse marriage and also the liquidity infusion by central banks, we have seen yields move up by about 10 basis points, particularly in the near term. Economic news obviously has not been taken note of much, but definitely they hold a lot of water for how the economy performs going forward, which in turn will determine whether the central bank or rather the Fed will hike rates or not. Their meeting is coming up in 2 days' time. University of Michigan preliminary survey showed that the sentiment index fell from 67 to 63.4. And more importantly for me, the inflation expectations have fallen both on 1 year, from 3.1 to 2.7, and the 5-year inflation has fallen from expectations have fallen from 2.9 to 2.8. Obviously, the current crisis and the impact on employment and consumption will tell upon the inflation going forward, which will enable Fed to take a more dovish view, even if they do hike in this meeting, which is still a toss up. But I think they might actually go for a pause after this meeting. And but if you look at money markets are showing once again the terminal rate being at 4.78% and possibly 100 basis points cut by the end of this year. So that's again, quite a divergence from the Fed's expectations of about 5% or 5.25%. Meanwhile, China also announced a 0.25% cut in their reserve requirements, which obviously is meant for their domestic economy. But again, we cannot rule out that it has some linkages with the ongoing global financial stress as well. And if you look at it, even our own central bank infused more than 1 trillion of cash, 1 trillion rupee of cash, which is the largest infusion in 4 years. But again, don't confuse it with the global crisis, because this is more to do with the liquidity conditions in the markets now after a huge tax outflows that is usually seen in the month of March. And also the call money rates were touching 6.8%, much above the repo rate of 6.5%, and even the MSF rate, which is at 6.75%. So I think this is more to do with in the domestic liquidity conditions, which could ease out because there's a unspent cash of more than 1 trillion of the government, and as that is spent, I think liquidity will ease out in the domestic market as well. And as far as the dollar is concerned, there is definitely a bias for more weakness because US yields have fallen. US is the most affected out of this, as of now, the most affected in this financial crisis. They are infusing more and more liquidity. Fed's balance sheet is again expanding in whatever way it is. It's not QE, but it is in any way it's increasing. Fed's balance sheet is increasing. So all these things, the differential with other markets or other currencies is narrowing. So I think dollar is set to weaken more in the, if not immediately, but in due course, I think dollar will weaken more. And Japanese yen, which has been in a range for some long time, I think that can be, headed for more strength in the coming days. As the dollar is concerned, I think it seems to have not been affected so much by this crisis. Of course, we did see it trade below 82 beginning of last week in the early stages of this crisis. But again, 83 attempts were thwarted by the central bank efforts, and we did not see any major volatility. Since then, we have slipped into a narrow range. And but for these global events, probably we would have seen some more flows into India, seasonal flows, but that probably is so far not happening. which is keeping the dollar rupee quite subdued. Thank you.
Okay, JK, that's quite interesting, and I really love the point uh, of marriage done at a gunpoint, and I guess the uh, foreign nations are now learning the ways, one of the ways, many ways of Indian marriage. That is quite interesting to watch. But other than that, yes, there is a lot of money being withdrawn from the smaller institutions and moving towards the larger institution in wake of finding some sort of security or safe haven against the regional banks in the US. And even though we are saying there is some bit of uncertainty with respect to the whole of financial markets, but we are definitely seeing one thing, that the Fed's balance sheet continues to rise, even though they had aimed for QT, and it may not be through QE, but in different forms or formats. And if we have to talk about the liquidity backstops provided, there was also some sort of liquidity infusion by the Indian central bank, and it was not majorly a phenomenon of the global crisis, but also because of the some sort of liquidity shortfall or liquidity crunch due to an extensive tax outflow during the month of March. That's a lot of things going on in the financial markets, and yes, folks, we also have the central bank meeting this week, so let's see how things go about, and we shall continue to keep you updated. Thank you so much for listening, and we shall be coming up tomorrow with another round of update.